Good afternoon, everyone. I hope you're all safe and taking adequate care of yourself as well as your near and dear ones. Welcome you all to the FEDI Monthly Discussion Forum. This, as you all know, is our first such discussion for the year in the year 2022. January, first month of the year, is generally the time for all of us to pass New Year resolutions on the personal front, which we invariably keep reviewing year after year. But when it comes to the professional life, this is an exercise we all take quite seriously. This is the time to review, introspect, predict, and also to prepare and project ourselves for the next year. This year is no different except for the fact that the situation we are now facing is pretty unique. Current market positioning is unlike what we had been seeing in the previous years, has got no semblance to what we have learned from the experience in recent history. What we are experiencing presently today is a weird situation of high demand, presumably supported by easy monetary policy, and struggling to cope up with the demand, not able to clear the backlog, tight labor market, inflation continuing to stay higher much longer than initially expected. With all these things in the background, central banks are indicating hike in interest rates, which many fear might trigger recession or stagflation, as global recovery seems to be losing momentum. I'm sure you would have noticed the recent downward revision by IMF. And all that is happening because of resurgence of COVID-19 or the emergence of new variants of COVID-19. To untangle this maze, help us understand better what is happening in global stage as well as our own markets, get better clarity, and to be able to understand and prepare for the future. Today, as part of our monthly discussion series, we are happy to have with us Shri Ashutosh Khajuria, Executive Director, Federal Bank. We also would be looking forward to his request him to share his views on what can we expect in coming union budget and the monetary policy. I don't think Mr. Khajuria needs any introduction. Just I'll do a bit of formality. He is an Executive Director of Federal Bank, overseeing the functions of Treasury, credit underwriting, monitoring and collection, environmentally sustainable growth, legal, and also the IBU in GIFT City. He is a man of many aspects, varied interests. He is a graduate in science, Bachelor of Law, and also a postgraduate in economics. He brings with him very rich and varied experience in banking, spanning over 4 decades, having also worked in State Bank of India and IDBI Bank. Mr. Khajuria also has been a director on FIMDA board from 2011 to 2016. He has a very keen eye on financial markets and features regularly on various news channels. Welcome, Ashutosh, to the FEDI discussion forum. Happy to have you today here with us. Let's begin with the latest. I think what is on everybody's mind today might be that yesterday's Fed meeting and the result announcements of that, which instead of going by what Fed said, if I just see what the market is reading into it, is a clear indication that there are going to be interest rate hike. Fed is going to start hiking from probably the March meeting. And if I look at the way futures are pricing, there is a pricing reflect almost 60% probability of 4 interest rate hikes in the year 2022 itself. And we all know inflation is at 4 decades high, and that's how the market is projecting and looking at it. With that thing in background, Ashutosh, I would like to first begin with what do you read in what Fed has announced? Do you agree with the market interpretation? How is it going to impact the global market? Because we are looking at not only the interest rate hike, whether they do the 3 hikes or 4 hikes, and how it continues in the 23, 24, and what are they going to do with that huge balance sheet which Fed has created, almost 9 trillion, how they are going to move on that, and how from there we'll move into how is it going to spill over to maybe the emerging market, especially our own Indian market, and then we'll talk about the domestic markets. So over to you, Ashutosh, and welcome to FEDI once again. And please feel free to add or maybe bring in a new aspect angle which you feel relevant. We'll be happy to have you.
So thank you very much, Ashwini, and thank you for having me here in this discussion. Well, I think the recent could be yesterday's Fed announcement, and basically the factors there are, the central bank as its prime responsibility once again is talking about price stability. They say inflation target of 2% has been far exceeded. Labor markets are strong, and the economic activity is quite up, and therefore it's high time they should look at withdrawing the easing part of it. The flip that was to be given to growth has met its objectives, and therefore all the more necessary that now they should look very closely on the price stability part. In the meantime, even commodity prices have moved up. We have almost 50% increase if we compare, almost in the last 12 to 18 months, the price of crude oil. Commodity prices have also had their run. Various, yes, you have said that, recently IMF has come out and they said, some steam is going off and all. But the risk of stagflation, therefore, increase in inflation, but not commensurate growth is something, which any central bank would be more concerned about. Naturally, the largest economy would be the first to act or so, looks like. So I think the hike may come, as early as maybe March. As you rightly said, there are expectations that there could be 4 hikes. But then don't forget, between 2004 to 2006, we had 17 hikes in roughly 15 to 18 months. So we had 25 into 17 roughly, this thing. Now in this particular century, there had been 2 global events which have impacted the global economies, of course, all simultaneously, more or less. One was, of course, the Lehman meltdown, and as a result of that, the global financial crisis. And the second one has been this pandemic. One was out of excesses by the financial sector. The other one was probably the excesses by the production sector and playing with nature or whatever it is. I don't know. Actual reasons may come out, in decades to come, probably, when we would know why this pandemic happened and all. But then that's the fact, which has impacted the entire world, entire globe. Now, looking at, what happened in India, it's very important to just look at that part, what happened post-Lehman in India. And as a result of, following the rest of the major economies, we just looked at, pumping in liquidity in the system. And in 2000, FY10 and FY11, post-Lehman, Lehman happened, post-Lehman, we had put up that much liquidity in the system that our growth rates continued to be around 9% plus. Probably, we thought that we are now, decoupled with the rest of the world, and therefore India still can grow and all. But that was not to happen. The results of that were double-digit inflation. In FY13, when for the first time, I would call it a sneeze in US, which impacted the rest of the world, but more so the so-called Fragile Five, India being one of those in that list. And therefore, on 22nd May 2013, when this announcement was made by Ben Bernanke that we would look at tapering. Now, instead of buying $80 billion worth of papers every month, they would gradually reduce this number or so. And the impact in next 3 months from May 13 to August 13 was such that rupee just fell like 9 pence, from almost 54 and a half levels to 68.85 on 27th August 2013. And I'm comparing why, because post-pandemic, again, there was quantitative easing, lot of liquidity injected in the system, same in India. And inflation situation also in India has come to, WPI certainly is in double digit. In those days, we used to just measure WPI, which used to come in, every Friday. We used to have those Thursday, Friday. We used to have those numbers, and WPI was the one which even our central bank was watching. So in October to December 2012 quarter, our current account deficit also had gone to one of the worst 6.5% of GDP quarterly number. And overall for the financial year 13, we had 4.8% of GDP as our current account deficit. So we had a brief period where we had the deficit on capital as well as on current account. Now, just compare it with now what's happening in India. Now, of course, the impact is so fast that if we see 2-year US Treasury as compared to 31st December itself, 1 month is not yet over, and 2-year T has already moved up by 46 basis points. It used to be somewhere around maybe 73 or 74 basis points. If we really are looking at getting integrated with the rest of the world, and now recently, as there is a talk that in this budget we may have certain tax related issues sorted out for Indian sovereign debt to be included in various global indices, and the expectation is that this is a new demand that is going to be created. Then I think it's all the more necessary that currency should remain stable. And that's very, very important, because if there is too much of volatility and if you suddenly see 20 to 25% of value getting eroded, no amount of yield actually would attract any investor worth its salt. So it's all the more necessary to have that volatility contained, reduced. Now, vis-a-vis 2013, how are we placed now? Now, as regards current account deficit, we had been surplus as late as maybe 6 months back or so. And now, gradually moving towards, current account deficit. And reason is there's a huge trade deficit. We had all-time high exports of nearly $38 billion in the month of December. But against that, we had something like $59 billion of imports. So the trade deficit, it had been all-time high, closer to $21-22 billion in a month. So I think it's important to then see, what type of trade in merchandise, deficit on account of trade in merchandise is going to be. And the likely number looks like for the year as a whole, we may have something closer to $200 billion or so. If that be the case, then I think we are looking at something like 1.5 to 1.75% of GDP as our current account deficit. 1.7 is, I think most of the commentaries are referring to. So we are back to that current account deficit zone. Current account deficit is not bad as long as it is moderate and it is reasonable, because whatever is your domestic potential of savings and all, current account deficit just gets added to that it's a foreign saving invested in India. And suppose if your savings rate is somewhere around, say, 30%, 28, 29% of GDP, you add this current account deficit to that extent, the potential growth rate goes up because you have that much of investable pool. So now coming to how are we placed in all? Yeah, we have comparatively a better possession, reserves in excess of $635 billion. Even foreign currency assets alone, if you see, they are also in excess of $570 billion or so. So I think if you see the accretion in reserves over 1 year, it's closer to $50 billion. Of course, if you look at the foreign currency assets part of it, it's only $29 billion because the rest of it is because of reallocation of your SDRs and the revaluation of gold and blah, blah. So even if it is, nearly $29-30 billion, we are not having depleting reserves, as was the case, in 2013, where maybe milder interventions actually led to the reduction in reserves, and reserves went down to as low as $257 billion from closer to $300 billion, $280 billion or so. So vis-a-vis that, I think there is an I would say arsenal available with with the central bank to see that there is no sharper depreciation of the currency, and they've demonstrated it. Recently, we saw that when they suddenly saw that dollar rupees inching towards 76 and all that, they intervened. So I think there is a willingness to really demonstrate and see that volatility is reduced to that extent. Now, coming to how other factors, other than this current account deficit and your stability of foreign currency, how otherwise we are prepared. Now let's look at the inflation part of it. Yeah, the central bank now looks at these consumer price index, and consumer price inflation had been quite okay, if we may say so. For the financial year 22, RBI's projection is that it's going to be 5.3%. But when you look at WPI, it's again in double digits, and it's hovering between 12 to 14% and all that in recent months. This is important. WPI we cannot rule out totally, and yes, for policy actions or so, central bank definitely would be looking at the consumer price inflation. And in the recent monetary policy of December 2021, they have projected inflation for Q3 at 5.1% and for Q4 at 5.7%. And similarly for next financial year, which is FY23, for first quarter, they are looking at 5%, and same for the second quarter as well. So that looks to be benign, but I don't know how it shapes up, because for quite some time RBI had been overstating the inflation fear, and the actual numbers were much lower than that. But of late, it's the other way around, where the actual numbers are coming out to be more than RBI's projections. But how much would be the variation? How much would be the variance? Only the time would tell, and we can see that. I think GDP numbers also, for the year, RBI continues to maintain their projection of 9.5%. This GDP number is also very important, because if your economy is growing and you have the currency to be stable, not so volatile, then you still attract lots of capital flows into. So FPIs, though, have withdrawn quite a lot in the current financial year. So therefore, I think, of course, the big question mark is, would they be interested when the normalization is going to happen in US, and what would be the impact on overall all emerging economies? But lots of commentators are of the view that India and Indonesia stand out. They stand out, and because of their fundamentals, because of their growth prospects and all, it looks like they still would have a good chunk of funds getting allocated to be invested there and all. And in the meantime, as all these negatives are getting built up in yield curve, you may find at some stage, some level, that your interest rates, your sovereign debt, and correspondingly the other debt also becomes attractive to invest. Now, let's look at the numbers. Ashwini has asked me to speak a little bit of my expectations on the budget and coming monetary policy. So I think one is, of course, on monetary policy, it looks like we have it very shortly, another week or so, we would come to know. Looks like, I think Fed's decision would certainly have its role. I'm not sure whether the hiking of policy interest rate happens, immediately or not, or it can be deferred to next policy or so. But one thing is very clear, with the actions taken on liquidity front, from backdoor, you can say the hike has already happened. When your 3-day variable rate reverse repo or your 1-week variable rate reverse repo yields somewhere closer to repo rate, in the 390 series, 93, 96, 99 and all that, then I think your overnight rate also gets pushed up, and it is clearly being seen. We can see it, how it's trending and all. Already over 1 year, if you just compare 31/12/20 to 31/12/21, your 3-month has moved from 3-month sovereign has already moved from 3.01% to 3.59, nearly 58 basis points move, and your 1 year has already moved by almost 100 basis points. Now, that is very clearly evident over 1 year, and after that, you are still seeing the yield curve inching northwards. Now, coming to the type of collections and what type of fiscal deficit would be there, because I think when we are talking of budget, we are definitely talking of what is going to be the market borrowing program, what is going to be the fiscal deficit and all. Now, I think the projection in last budget about the estimated GDP for financial year 22 was around 223 trillion rupees, 223 trillion rupees over a base of 195 trillion at a rate of somewhere around 14.4%. Sorry, around 14.4%. But I think it looks like that the nominal GDP, which is on very, very important to compute at what type of revenues would be coming and what type of fiscal deficit would be there for your budget numbers and all. It's not the real GDP, it's the nominal GDP that matters. So if you see how is it projected, it's taken as, what is your, at growth at constant price, means your real growth rate plus average of CPI and WPI. And because WPI is at an elevated status and elevated level of 12 to 14% in recent months, double digit in recent months, the average of CPI and WPI is estimated to be closer to somewhere around 8% or so. And if your GDP, as RBI also is, repeat, even after review, they are sticking to that 9.5%, then I think we are looking at a nominal GDP growth of closer to 17 to 18%. We'll know it very shortly on 1st February. We'll see what are the revised estimates, and accordingly, we can see that what type of GDP numbers are coming out. Looks like the number could be closer to 230 trillion as against 223 trillion projected. Now, your denominator is known as 230 trillion. How much is the borrowing and how much is going to be the fiscal deficit on that? Even if the deficit in absolute terms is more than deficit projected was about 15 trillion. So if deficit goes beyond 15 also, it has some room to still stick to 6.8% of GDP as a fiscal deficit. This is an important sort of development. I think the revenues have been quite good, and revenues are function of the nominal GDP growth. If you have more of, and plus the, of course, enforcement, if you are in a position to properly recover the tax due and all, then I think there is a room there also to increase your tax revenue collections. There could be some slippage on the non-tax revenue. Probably that slippage also is going to be on the positive side because you had a higher dividend coming in from Reserve Bank of India. So on revenue front, on revenue receipt side, there's going to be a much higher number than what was budgeted. But on the capital receipt side, if you look at the disinvestment, capital receipt on account of the disinvestment, then if LIC IPO doesn't happen in this financial year, then you may have a big slippage there because that number is projected to be 1.75 trillion altogether. And the present score is hardly anything to mention, hardly 10,000, 11,000 crores or so. So I think a big gap is going to come there. But if revenue collection, as is expected, is going to be more than 2 lakh crores or so, over and above, the projected one, then I think we can somehow look at the same numbers and all. So your market borrowing program may not be impacted too much. If at all they borrow, I don't know whether they'll come to borrow through the normal auction route, or they still would take this money through the small savings route, which they had been doing quite often. It's very important and pertinent to mention that of late, our market borrowing is hardly 60 to 62% of the fiscal deficit. So as against 15 trillion rupees of fiscal deficit budgeted, you have nearly 9.4 trillion or so, which is coming as a net borrowing through this market borrowing program. I think 12 trillion is gross, and there are repayments somewhere around maybe I think net is likely to be 9.3 trillion if no additional borrowings are resorted. So I think that's about the scenario as far as the budgetary expectations on the current year's performances there. Now looking forward, I think there is there was a statement made by our Honorable Finance Minister in the earlier budget, last year's budget, and she had said that yes, from 9.5% of GDP, we have already come to 6.8% of GDP budgeted for this financial year. But going forward by FY26, we will bring it back to 4.5% of GDP, FY26. Now, this number is very important because the similar number, similar percentage, not in absolute terms, but in percentage terms, was there in FY20. FY20 is the year where 11 months were of a normal pre-COVID year, and there was only 1 month of March, where you had, of course, March is very, very important, and lots of collections, revenue collections and other things got impacted because of that, and you had a slippage. Because year prior to that, we had come to as low as 3.4% of GDP as our fiscal deficit in financial year 19. But in financial year 20, we slipped to 4.6%. Under FRBM, we are supposed to be at 3% of GDP. But I think the roadmap that has been given, if this year either we meet the fiscal deficit target of 6.8% or improve upon it, we still are far off from 4.5% of GDP, which is to be achieved in next 4 years. So my assumption is, or I think in FY23, we can look at anything between 6.2 to 6.3% of GDP as the target fiscal deficit for FY23. So that may result in your, gross borrowing of same level, 12 trillion, assuming that there is a 12 to 13% of nominal growth rate projected. If nominal growth rate in GDP is projected to be somewhere around, say, 12.5% or so, nearly 13%, then you can have same 12 trillion as gross borrowing, but net would be much lower because you have a lot of redemption. you have nearly 3.8 trillion redeeming government securities are redeeming in FY23. So you may have net market borrowing of 8.2 trillion as against 9.3 trillion budgeted for the current year. So that we would know in another 3-4 days when the revised estimates are presented and budget estimates for FY23 are presented. And my my projection is I'm expecting that to gradually move from 6.3% to 5.8%, 50 basis by FY24, and then 5.25 by FY25, and 4.5% of GDP as was announced in the earlier budget, 4.5% by FY26. So these are some of the forward-looking, or rather expectations I have from the budget. And in the meantime, I think what we have to look at is the fear which Ashwini had raised, the red flag, stagflation. So we have to watch out for that. If inflation, as projected by RBI at 5% continues to be there, then we are well within the band. And when we are well within the band of 5%, I don't see, at least for India, the stagflation coming, in the near future or so. You may have, growth rate, at least, a nominal of around 12.5%, and your real growth rate of closer to 7 to 7.5% for FY23. So Ashwini.
Oh, that was very exhaustive, and that's exactly what, whenever I talk to you, the kind of grasp you have got on the topics and history, as well as all the recalling all the past instances. So I'm not going to summarize. It's not possible for me what you have said to summarize that. It's beyond me. So what I'm going to ask is some of the points which stuck with me when you mentioned. The first thing which you talked about is you once again brought into focus that 17 hikes in 2004 to 2006. And that reminded me of the previous hikes also, when the interest rates used to be hiked by, even at one time, I think they hiked it up by 2%. We know the situation today is much different. As I said, the market is expecting gradual hikes, and central banks also are in a position which they have, based on the past experiences, don't want any surprises in the market. But today, the first question which is coming up is that in March, they have made it very clear. They have indicated there is going to be the first hike. What first thing do you expect that, because of the things which people are talking about, Fed is behind the curve and it's already delayed? How much possibility do you see of a 50 basis point hike in the March that I'm talking about, the Fed? First piece. Second point, which you mentioned about that 2013, despite all the confidence and all the positives we were thinking we were clubbed as fragile 5, and we had to face the music or the taper tantrum which we talk about. But you have explained today the situation seems to be much better in terms of our reserves, in terms of our current account deficit position, though we are moving from surplus to deficit once again, but it's a much better position. And the way we have been managing in the past also, you have indicated that position seems to be much better. So are you pretty confident that yes, we don't need to worry about the kind of situation which we faced in 2013? Because we are inching towards a similar situation. And if you look at the reactions of the market in the past few days, that is again showing the kind of lack of confidence and kind of runaway. Whenever something happens like that, pull back the liquidity from the emerging markets, go back to your home market, go back to the safe assets kind of thing. That kind of situation, though you mentioned about the bond index and we would like the money to flow in, but how confident you are that rupee is not going to face the kind of pressure which we saw that time, maybe 25% depreciation within a span of 3-4 months? I can expect maybe it's not going to be as bad, but do you feel that rupee will hold its fort? If not, how much depreciation you expect in the rupee in the current year, maybe we can say? Yeah.
So if you just look at the inflation corrected parity, and if we go by the inflation rates in US and the CPI rate of inflation in India, I think presently both are neck to neck. So if you see about, the numbers, I think theoretician would say there is no need for further depreciation also. But that's not correct, because why I'm saying is because, I think number one is the quality of data. I'm not questioning totally that much, but overall, if whatever said and done in case of emerging market, the perception hits us more than the OECD markets. So perception naturally, brings in lots of, kinks and sudden jerks, and, some of those so-called fundamentally sound bases also, gets shaken. Now, there are three things which are very, very important. One is, of course, the reserves, which I already spoke to you earlier. Number two, in India, earlier there was no such band, inflation band, rather price stability band, set as a legislated target or mandate given to central bank. So earlier, there was no such thing which was legislated. Now we have a legislation which says RBI has been mandated to keep that band between 2 to 6%, 4% plus minus 2%. So now there is focus there on price stability much more than what it used to be in earlier days. That's number one. But at the same time, growth was an important thing. I won't call RBI was behind the curve and all that, but fact remains that, post-COVID and all, the unorganized sector, measuring their size is really a big challenge, going by whatever data points we have, and the collection of data related deficiencies or so. It's very difficult to really say, because there are nearly 4 crore small and medium enterprises. Some say if you add the single self-employed professionals and all, the number crosses 10 crore. Now, with 10 crore enterprises and all that, some of them we don't know any number about them, what type of earnings they were making and what type of earning they are making now and all. But the fact remains, yes, there is a shift from unorganized to organized. There is no doubt some of the numbers look quite good. Your employment data also recently, the ones which have come out suggest that there is a good so-called growth on the employment side. But I think it's very difficult to really measure what type of actual permanent hit or semi-permanent hit it had on this thing, because your MNERGS data also says there is a lesser number of hours being asked for by the rural folk. So either recently they had been busy with their rabi sowing on their own fields or so. Now, of course, this is the time when it would be tested actually, whether they actually intend to come back. Because in January and February, you need very little attention towards the fields and all in case of Rabi. They say dew takes care of everything. You have to take care of only protection of the crop. And maybe in very rare cases, you have all those tiddy attacks and all those, the pests and all. So if you can protect against that, there is no need for any irrigation and all. So whether it is wheat or, your gram or mustard, or, all these three they have been properly, the required irrigation is already done and all. And rest of it is on nature. Now, this is where your farm labor would be least used, at least till second half of March, when the harvesting would start. So in Madhya Pradesh, it starts early, so maybe second half of March, and then in Punjab, sometimes in Punjab, Haryana and all, sometimes in April or so, you would have once again requirement where you would need, the farm labor to be put to this thing. And then we would know actually how much is engaged by farm sector. We were very lucky that we had consecutive 3 very benign monsoons, and that those were at the time when COVID had hit us and all. So I think overall preparedness wise, we have our granaries overflowing, and this is where I think the free food grain scheme has worked very well. On one hand, you could procure it from the farmers. On the other hand, you could distribute it, though of course at the cost of the exchequer, but that was the best way to actually provide the cash support and all in the form of grains, and all that. So rather than simply crediting the accounts or so. So I think your warehousing related thing also had been taken care of. We do not have enough storage capacity in India, so this was the best thing to do. So overall, if you see, I think the target of that band 4 plus 2% would always keep a check on the measures to be taken for checking price inflation. And that is where I always would find it really positive for the bond market, that you can't now expect a 10-year going to 9% or 8 handle or so, which we used to have quite often in the past. So that is where I think probably maybe above 7 itself, for I'm talking of central government benchmark, 10-year benchmark, compared to that with SDLs and all. SDLs already are in recent auctions have touched 728 levels or so. So probably another 25-30 basis points movement, and people would find that to be attractive to buy. If you today look at the real rate of interest, I think if you go by purely like a theoretician, then I think we have a zero real rate. Now, why zero real rate? People would say, inflation at 5% and your 10-year is going at somewhere around 660, 665. So there is a spread of about, say, 1% plus or so. But that's not the case. When you are looking at inflation, inflation is a YOY number. YOY number, yearly number. So whatever inflation number is coming today, we go back 1 year and see what was a 1 year, risk-free return interest on treasury bill. So if you compare 1 year treasury bill, I think last year, same time, it was somewhere around 3.38. So you had, if somebody had invested in 1 year treasury bill at 3.38, 3.4% levels, and today inflation number YOY is coming out to be 5.5, and all those numbers, then he is actually getting a negative return. And today, if we have a 1 year rate coming somewhere around 440 or so, 440, 445, then I think what is going to be our projected inflation for 1 year from now? So all these numbers are important, and therefore I think there is a scope for yield curve to move upwards. But in case inflation as projected by RBI is capped at 5% in Q1, Q2, they are talking of 5% number, means first half of FY23 is looking at 5% inflation. Second half, we'll see, when the next policy comes in, they'll go one quarter ahead. And then we can see, as per their fan chart, how much they are expecting it to move to. So my point is, yes, there is a scope for interest rates to go up, but the spread between overnight and 10-year, spread between overnight and 5 years, spread between overnight and 30 years is almost all-time high. And that is where the real catch would be. So you may see interest rates going up, but not necessarily. Same like, US, you saw, your 10-year today has been rather negative, in US by 2-3 basis points. I don't know the current number, but in the morning, it was about 2-3 basis points lower than yesterday, while 2-year just went up. So we may also have a situation where 10-year may get capped at somewhere around, say, 7% or so, or probably even lower than that, or maybe around that. But your short-term interest rates are going to move up. Because if you see 10-year average, I was just looking at the historical spread, and my dealer helped me with that. Historical 10-year average spreads, repo versus 10-year had been 87 basis points. 87 basis points. And I remember, when I used to trade, I used to see, those days, 2003, 4, 5, 5, 6 and all, the spread used to be 50 to 75 basis points. So over 10 years, you see the average spread is 87 basis points. If you take the last 5 years average, because you have the COVID period included in it, this 10-year spread over repo had become 143 basis points. Just look at it today. Today, your repo is 4% and your 10-year is quoting at 663 or 660. So you are at 260 basis points. So this spread is going to get squeezed in the coming financial year. So on your point, how well we are prepared and why you say that India would be less impacted. We may not have your 10-year flying out to the earlier levels of in the past when we saw whether it was the post-Lehman, immediate post-Lehman period or so. Just before Lehman and all, we had around 9%, 10-year quoting somewhere around 9%. Then post this thing crisis of 2013 and all, again we saw 10-year shooting up like anything and going to closer to 8 handle and all. I'm not expecting that to happen this time for the reasons I have just mentioned. One is, of course, we have a mandate for our central bank to keep inflation in check and within a band. Even if that's a medium term, so even for temporarily breaches, the measures would be taken to bring it back to closer to towards 4 and all. So that's one reason. Reserves are there to take care of the volatility on the currency side. And I think that is going to be quite conducive to RBI's other measure wherein they would like to suck the liquidity out of the system to check inflation. For checking inflation, most important part would be to suck the liquidity out, and they have done it, demonstrated it, how without changing repo rate, they have actually brought the overnight rate by 40 basis points higher. So the overnight, which was quoting somewhere between 335 to 340 levels or so, now is around 375 and all that. So you have already seen there been no high, but actually there has been a high. If you see, through a back door, this thing by just taking liquidity out. And if they allow this VRR, at 399 and all that, you practically are talking of, having your money easily getting deployed with Reserve Bank at 399. So if you are having that, that's what becomes your base, because that's where your returns are coming out from overnight or 3 days or 7 days, even for short term, this thing, variable rate reverse repos, they are providing that type of, return also. And they are accepting the bids. Now, nearly 6-7 trillion of liquidity is to be taken out and all. In case suddenly you see, as you said, because of fragility or because being emerging market, you have withdrawal of, so-called, withdrawal from rupee assets, then you may have some, fragility coming to dollar rupee. And that is the time when RBI can intervene. And I'm just giving you some numbers, $10 billion intervention would mean sucking out of liquidity of something like 75,000 crores at current exchange rates. So 1 billion is 7,500 crores. So they would not be having any, opposite side of, action like what they used to have in last 2 years, where they were acquiring foreign currency assets and they were injecting liquidity in the system on one hand, and through OMOs also they were injecting liquidity in the system because they were buying government securities and therefore injecting rupee liquidity in the system. Now, what we have to look at is how much leakage is going to happen through currency in circulation. If you just look at the numbers year on year, your current currency in circulation is about 30 trillion rupees. Now, this 30 trillion rupees is about 2 lakh odd crores more than last year's level, roughly 2 lakh 20,000 or 2 lakh 30,000, around that, more than 2 lakh crores. Now, at 230 trillion rupees of economy, 30 trillion is what your currency is. Currency in circulation is, we are talking of something like 13% of this thing. More and more, digital transactions are happening. So there would be lesser absorption of liquidity through the currency in circulation route. So you may not have the same number, same type of number, 250,000 crores or 230,000 crores type of addition to the currency in circulation. That is another point which I want to highlight. There may not be OMOs wherein RBI would buy government securities, because that would also add to injection of liquidity. There could be lesser of that. But at the same time, governor has very categorically said that he wants an orderly behavior of the yield curve as well. So what he wants is there should not be any too much volatility either on or unreasonable yield, for the economy, which fundamentals don't suggest. So I think there could be some way some intervention happening through either OMO purchases, though logically they are not required, because if they are removing liquidity, they need not buy bonds or so. But if they see that there are no takers and all, they need to create a newer type of demands. I think fortunately in India, insurance sector is growing quite well, and gradually their share in G-Secs is increasing day by day. I think our banks now are only at 37%. At one point in time, they were having the 2/3 of entire GSEC outstanding. GSEC outstanding, other than the specified securities, roughly 80 trillion. 80 trillion rupees worth of central government securities are outstanding. 40 trillion, nearly 42 trillion worth of state development loans are also outstanding. So you have about 122 trillion worth of, central government and state government securities. RBI itself is holding something like 17% of the central government securities. They have very little holding in SDL, though they had zero. Gradually in last 2 years, they have increased it a bit. But that's negligible. That's less than 1%. In central government securities, they hold nearly 17%. I don't know whether they are going to really continue their OMO operations. I doubt, because there would be no logic when they are removing liquidity from the system. But if they have any alternate balancing sort of this thing, then probably we may have some of the purchases happening. And this is where the most important thing that may come in the budget, important for us market players, is that whether they are bringing in some tax-related clarity and all those issues, which actually would facilitate, India's, debt being listed, being part of the global indices. If that happens, then I think you can expect anything between 1.5 to 2 trillion rupees of new market available to, available for absorption of G6. So
thanks a lot, Ashutosh. I think we are already running tight on the timelines. And I will just tell participants, if you have got any question, you can type it in over there. Time permitting, we'll try to take questions if any. And before that, I have got one thing more which I would like to ask you is, we have got so many uncertainties, some of that you have alluded upon. And one more wild card which you have not touched upon is about the crude oil. How relevant, how for India, we know that's a very critical component. How much comfortable, or what do you see? What kind of worries, or as far you can say apprehensions you have on that front? How do you see that?
Yeah, I think whatever said and done, you may talk of EVs and various other things, but it's going to take time really to have a major impact on consumption of oil. So oil is something which India should be worried about and is worried about, because 85% of our requirement is imported. And that is very crucial. Another issue, I think this is quite akin to what we had in 2013, because that's the time when, again, crude was above $100. In fact, in May 14, when the new government came, it was already at somewhere around $107, $108 to a barrel. And then it started falling and all. So that was one issue. Crude was in 3 digits, and gold imports also in one particular year, which was FY13, we were closer to $60 billion. Now, $60 billion worth of gold, $150 billion worth of crude, those were the numbers. And this is the reason why your CAD had gone in for toss. Your CAD was somewhere around 4.8% of GDP for that financial year, FY13. Now, again, gold has, taken a toll. Lots of, gold import has happened. I wish with the global economy improving and purchasing power overseas coming back and all, in richer markets, there would be more demand for Indian gem and jewelry and gold and all. So if that is taken care of, probably that would give boost to rather than gold consumption. And we have SGBs also coming in and becoming more popular in India, and lots of Indians who want to bet on gold are doing it through paper gold. So that's also a positive development, but still it's worrying. In first 9 months, the gold imports have really been quite high. Once again, we are looking at something like $50 billion of, usage of our resources going in for gold purchase. Crude certainly is a big villain for us if it continues to be at the levels where it is, or rather, because 90 breached, 90 touched and all, I think 3 digits are not far off. So that certainly would bring some strain. Absolutely no doubt that we are better prepared vis-a-vis what we were in 2013, even to take that in this thing. And that is the reason where when revenue projections are going in, we are looking at, or rather, I had done, my own so-called estimation that we may still see more cut in excise duty. And that is the reason whatever growth we may have in GST would be balanced by the cut in excise revenue for central government. So central government may not have any rather growth in their indirect taxes. They may have 14-15% growth in their direct taxes revenues because of the earnings of the corporate sector doing well. That we have already seen in last 2 quarters, and the trend is on, whether it is, banking, financial sector or other sectors, the numbers are quite handsome. Even Maruti, we saw their numbers also. So I think overall corporate sector earnings are coming out to be quite healthy. And as a result of that, you will have more growth in revenue coming from the direct taxes, corporation and income tax. You will have practically no growth or negligible growth, 2-3% growth in indirect taxes. And that excise duty cut would probably take care of the general consumer of, petro products. On one hand, and on refining, I think we do 30% of what we import value-wise, we export through the refined products. So if that value goes up, maybe exports may also go up, but naturally only 30% is going to grow. 70 still would be a drag on our resources. So I fully agree with you. That's a challenge, and that's going to be the big villain.
All right. So before we formally close this session today, because I know you have got something else lined up at 4:30, you have already indicated about the topish range for the 10-year security, which you said anything 6.75-7% makes it look very attractive. New buyer interest will come in. Any call on the interest rupee exchange rate, dollar rupee?
I think to the extent of 2 to 3% depreciation, RBI would be very happy to do that. So allow that rather. But it has to happen gradual, not in a week's time or so. So over a period of a year, if about 3% depreciation happens, means I'm talking of 2 rupees 25 paisa on 75. So to that extent, I think it would be benign, not bad for us, for our exports to have the go for it. I think we are expecting. My expectation is next year's import should be in excess of 600. I'm talking of only merchandise imports. Merchandise imports could cross $600 billion, and imports around maybe 400 this year, and next year could be anything between 450 to. So your trade deficit is expected to be 150 to $200 billion for FY23.
So your projection of 2 to 2.5% may not please our exporters community, because historically we have been seeing rupee on an average annual rate of depreciation closer to 4%, I believe. And now, of course, as you said, that situation is much different. The interest rate yield curves are much closer. The differentials between the inflation differentials also have narrowed down.
If you want your capital flows,
I take that. So we can safely say something around 78 should be topish.
So if you want a capital flows to continue to come into India, and people do not just look at it that suddenly my profits have all disappeared just because exchange rate has gone adverse. So whatever I had invested in India, and then all the gains are just going for a toss just because exchange rate has fallen, then you will have the accelerated flight of capital. So I think if they hold on to exchange rate and see that it moves only in an orderly way and not brings in jerks and all, I think the confidence of investing in India, investing into Indian assets, into rupee assets would increase to that extent. And that is required for a growing economy. If we are looking at, more of capital formation and more of, investments coming into India and all, then FDI, FPI, in whatever form they are coming in, we have to, one thing we'll definitely have to be careful about is seeing that exchange rate is stable. And now we have the wherewithal to do that.
Great. Thanks a lot, Ashutosh. I think you have covered the entire gamut, right from the Today's discussion reminded me of one earlier session I had attended of yours, where you were explaining the various terms of budget, capital budget, what is the fiscal deficit, what's the current account deficit, and that stuck with me for so long, though many of the learnings might have faded away, but once again reminded me all those, the detail up to which you can go and the clarity of thought and the way you put it forth, really appreciate. And thanks a lot for giving time for this PEDI meeting, and look forward to more such interactions and more such communications with you in the future. Thank you very much.
It has been my pleasure. Everyone, stay healthy, stay safe. Take care.
Thank you.